had a positive job surprise today. Not enough, though, to boost stocks. Let's add it up here on the close. Michael Seery is president and owner of Seery Futures. He trades metals, soft and hard, grains, energies, currencies. He joins us from CME Group in Chicago. A few blocks away at our Chicago bureau is Lincoln Ellis, managing director of the Linn Group. He co-wrote the recent report, Recovery at Risk, and says that stocks are still on shaky ground even after the Fed's move this week. We'll start with Lincoln because, if you've been long, Lincoln, the ground doesn't feel so shaky. And then you look at today's jobs numbers. You got QE2 plus the jobs picture is getting better. Isn't everything okay? Aren't we in the clear?
Well, I think you have to think about both the pace of the recovery and the trajectory of the jobless piece to actually do the fundamental addition to understand where we are both in terms of the recovery and where we are in terms of stock prices. These kind of low interest rate environments tend to and obviously have been quite favorable for stocks. And given the kind of underpinning and excessive amount of stimulus we have in the system, one, you're not too surprised to see an uptick in the employment picture. And then secondarily, you're certainly not surprised to see the kind of run-up we've had ahead of this massive amount of stimulus that was announced on Thursday. So we're kind of right where we think we probably are.
Is it So it's working?
The question is, what is it working for and to whom is it working for? Certainly, it's important to remember, you remember A.J. Kapoor writing about the plutocracy in the late 1990s, early 2000s. And really the point of that work was always that excess returns in stock market values would create this wealth effect that would have a ripple through in a very positive fashion towards job creation. And I think that's what the Federal Reserve and certainly Chairman Bernanke are after in this situation. And given the way that the current plutocracy accounts for GDP spending, probably somewhere in the neighborhood of 30 to almost 40%, he could very well get his wish and maybe get some follow-through.
I want to just quickly ask Michael here, was everything priced in until just now? I mean, you'd think that the market would gain on these job gains, although you could say maybe they think that we're not going to get any more quantitative easing. How do you view it?
Right. Well, the last couple of days we've had the big rallies, so this was, baked into the cake. But really the story is, again, is the metals. Silver up another 70, gold, even crude oil up for the fourth or fifth day. The money is flowing into the commodity sector, and that's where really a lot of the action is to the upside.
All right. So, Michael, Adam Johnson here. Gold, $1,400, practically. I should say practically $1,400. That's a new high. Is this really the fear factor? I mean, is this the one thing out there that's telling you that markets really aren't comfortable with what's happening?
No, I don't even think that. I just think there's a lot of demand. Look at silver, almost at $27. Platinum, a $17.50. Palladium, that's used in a lot of car making. Now, these are all new contract highs for the year. I think there's just a lot of demand. And where there's demand, prices go higher. All of the grain products. Look at cotton prices, all-time highs. Look at sugar prices, 30-year highs. The money's really flowing in the commodities. And that's why the stock market's going up. It's basically a bigger commodity market. They want commodity prices to go up. It helps all the commodity stocks go up, and that's what's moving the indices.
Hey, Lincoln, it's Dominic here. Speaking on this theme of this international kind of commodity theme going on, a lot of people are saying, including Mark Mobius over at Templeton, that all of these kind of emerging market flows are coming in because basically QE2 is forcing people to go elsewhere around the world. Is this going to be one of those bad byproducts of all this liquidity in the system right now? People want to not be here anymore, but everywhere else but here.
Well, that's exactly right, and that's also what you're seeing. I remember Adam talking about it earlier in the week. Commodity markets, you have to remember, are infinitesimally smaller than most of the other publicly traded securities markets. So when you have investors looking for alternatives to both fixed income, which people feel quite unclear about, particularly in a potentially a rising rate environment, and stocks, which they've gotten burned 3 or 4 times in the last decade, obviously they're looking for alternatives. When that amount of money goes heading towards those very small entry points, prices move at exponential rates, and that's absolutely what we're seeing. It's for us what we're fearful of in terms of the adverse effects of what policies like QE2 could bring about. With oil screaming towards 90 and quite possibly $100, it'll put a very large crimp in terms of consumer consumption, particularly in the developed economies, but also will weigh on international trade as export-driven economies like Southeast Asia, Japan, and Brazil really will struggle, both at a currency level and an export level, to keep a pace with those higher commodity inputs.
Hey, Michael, watching just the upward momentum in so many different asset classes, whether it's equities, whether it's the commodities, I mean, do you fight it at this point, or can you not at this point because the trend is too strong?
I still think the trend is there. You just might have to deal with the option markets or trade small because the volatility is very high. Silver was up $1.80 yesterday, up 70 today. You could have a $5 up day, a $5 down day. You could have a $100 up day in gold or down. So the volatility is definitely there. But these markets are for real. The government wants higher prices, and they're getting them, and they're going to continue to get them until they stop what they're doing.
I mean, go ahead.
Well, no, Lincoln, I want to ask you, I mean, do you think that's one of the reasons that we got a stronger jobs number, that the Fed is telling everybody, look, we're going to flood this market with money. People are going to obviously go and buy a lot of commodities with that, and commodities producers contributed a lot to the jobs market. I mean, is QE2 in a way working for the jobs picture here?
Well, I think what we did was the simple addition of putting together the inventory build numbers from the summer and the uptick in factory orders from the previous month, and that simply gave us a number right at 100,000. 150,000 was simply because we haven't begun to see the kind of state and local layoffs that we'll see in 2011. But the pace, remember, it's about the pace of change. When we were at these levels, at these highs in April, we were expecting a 3% GDP number for 2011. We're now expecting 2.4, and we were at $100 in earnings for 2011, and we're now just barely at 95. So putting the math back together at this later stage in the recovery, when we're clearly slowing down, I'm not quite sure why investors are paying up here, other than that we are absolutely going to inflate these prices. Michael is totally right.
Liquidity.
Exactly.
I only know that because Lincoln always tells me that when I message him every day and say, dude, why are you so pessimistic here? Why is the market continue to go up? And he writes back in all caps liquidity with 3 exclamation points.
Well, what about the train leaving the station, Michael? Do you get that sense down there as orders come into the floor that the retailers have, frankly, just been left out?
I still don't. With repricing these commodities at this low dollar, we're going to go, we're still several hundred points away in the dollar from 2006 lows. We even test that. You're going to see, you could literally see silver in the mid-30s, and you could see gold at 1,800, and you're going to see crude, in my opinion, above 100. It's just the demand is there. People want it. It's 2008 all over again, but instead of the banks buying it, it's the federal government pushing it. Even better, they have deeper pockets.
Lincoln, do you agree? Could you see prices up that high? I mean, will your liquidity really boost gold to $1,700?
Absolutely, Matt. And for your birthday present today, we should probably buy you a bar of gold.
You should.
And stick it in a vault and get it, and we'll give it back to you next year on the 5th of November.
That is such a sweet thing for Lincoln to say.
Can we charge him interest on that?
Lincoln, I want to ask you, because you've been so bearish. We always kid you about wearing your bear suit and, getting rid of it, and you obviously haven't. I mean, what's it going to take to change your mind here? Because we are seeing better economic statistics. Take today, for example. I mean, things certainly do feel better. What's it going to take to change your mind?
Well, as we've always said, Carol, we're just trying to be constructive about and cautious about how we go about putting money to work at a particular time in the cycle. And while we continue to be bearish, it certainly hasn't prevented us from being involved in these markets or being involved in places like commodities or gold or things of that nature. It just allows us to sort of temper our enthusiasm so that we don't get carried away on the upside and that we aren't surprised on the downside. And that's really, what we need to be conveying to investors out there.
You're more bearish on really the economy, and you look at the market constructively because of all the liquidity coming into it. When does that turn around, though? And does it end in kind of a horrible drop?
I don't know when it ends in a horrible drop, but we're right at the kind of a place where we spent 2.5 months rallying in the spring, and we spent the last 2.5 months rallying here.
Okay.
Europe is bubbling over. It could happen again.
Hey, we're bubbling over here, too, because Mr. Miller has a birthday, Lincoln, and I know you wanted to do something for him.
Uh-oh.
Happy birthday to you. Happy birthday to you. Happy birthday, Mr. Matty.
That's so kind of all of you.
Happy birthday to you.
That's the first time I've first time I've heard Lincoln sing in English in so long. Thank you very much, Lincoln Ellis.